Welcome to this Steadyhand Fund Update. I'm Tom Bradley, Chair and Chief Investment Officer of Steadyhand Investment Funds. Today we're going to review the Global Small Cap Equity Fund. And with me to do that is the Portfolio Manager in charge, Magnus Larsson from TimesSquare Capital Management. Welcome, Magnus.
Thank you very much for having me.
You're in Vancouver. Have we converted you being a Canucks fan yet?
You're getting closer. You know, as a Swede, I'm very proud of the Swedish presence now and previously in the Canucks. So we're getting there.
Well, we'll keep working at it. Okay, well, let's get started and talk about performance. The fund's been around over a year now. The results have been nothing short of eye-popping. Maybe you can give us a sense of what's driven those returns so far.
Well, it's the same thing that we will hope that will continue to drive returns, and what we've seen in the past and what we've done is that there's a very high correlation with our companies performing well economically. They continue to grow, to have good results, reinvest to grow further. And there is a long-term, very high correlation between, call it economic prosperity of a company and the resulting share price.
Any specific, sectors or themes in the portfolio that did well?
It's really been across the board. We are, looking at this as more of a general approach. I don't have a potential favor sector or not. Sometimes we're overweight one sector or not, but it really comes to finding the right companies and their ability to grow their business.
Now, true to your discipline, as these stocks climbed in value, you sold or trimmed some at the end of the year. Maybe you could give us a few examples of that, and then where did you deploy that capital when you did sell them?
Absolutely. So we have reduced some of our biggest positions and gotten out of some of very large positions, duly because they performed well and valuation was rich. There's nothing wrong with these businesses, and in fact, if some of them come down and become attractive, happy to buy them back. One of the biggest holdings we sold out of was Open House, a Japanese house builder that, looking back 2 years ago, everyone hated for no particular reason other than that was out of favor, but the business was great. The stock more or less doubled last year, became fully rich. We're out. Apollo, a private equity manager, did really, really well for us, and we have been trimming that significantly. So, the trims have been, basically on strength.
And when that money comes out of those stocks, where has it been going?
So, it's usually a gradual process. When we buy into new names, we let them grow into the portfolio by proving their business. But in this case, we actually added a couple of names in Japan more recently. Kobe Busan and Sushiro. Kobe Busan is basically an Aldi, discount retailer. Japan has had a struggle economy for a long time. It's struggling with demographics, and people have become more and more frugal. So this is a very good operator in that sense. Sushiro is a kaiten sushi provider. Basically, those running sushi go and there's a little belt that runs them around. They're also just very good at what they do. And interestingly enough, they actually use robots to make the sushi. And the savings they make on using robots, they reinvest in getting better fish, which brings in more customers, which make them grow. And they're also now successfully taking that outside Japan.
Well, speaking of robots, this fund has more technology in it than really any of our other funds in the lineup. There's a perception, certainly, that technology is pretty expensive these days. Where are you finding the opportunities?
It's interesting you mention that because we need to look at the definition of technology. When people think about technology stocks, often they think about the FANGs, if you want, or I call them FANG offsprings, would be in smaller companies. We're more into everyday technology. One of the biggest holdings that we are, is Altron, which is an R&D outsourcing company. They're basically a manpower for rocket scientists. And when you go outside the immediate, call it online app, that space, there's tons of technology providers. Another one of our top holdings would be Gartner Group. They don't actually do anything in technology, but reviewing technology. Yet they have the ticker IT. So yes, we have technology, but it's not the kind of technology that people usually think about when they hear tech stocks. That's not a space we want to go on. We want profitability, we want positive cash flows, we want reasonable valuation. So we stay away from that crowd and we go in the other ends.
And I think you've told me before that you actually like non-technology companies that are using technology to go up the value chain.
Absolutely. This is actually our strongest preference. And we have some great names. We have a big holding in Top Denmark, a very mundane insurance company. They will insure your car, your house, your motorcycle, your barn if you're a farmer. But by using technology and investing more and more, they are better and better at pricing risk. So here's a good example of a very mundane industry that is using technology to improve the profitability of what they do.
Now, you've also mentioned to me that you like companies that build something that's critical to the kind of the value chain of their customer. Might not be a very big piece, but it's critical. What would be an example of that?
One very mundane example in everyday life that we take for granted, but is doing really well, and is RPM. It's a US company that basically makes glue and sealants. You know, when you glue something together, usually you glue two important things together. The glue in itself is not important, but yet if the glue fails, the bigger parts also fail. And that would be a good example of being a small but mission critical part of a value chain and ability to get paid for it.
Okay, turn in another direction, insurance. You know, I don't think of insurance as being kind of, you know, the realm of small cap investors, but you've got a number of stocks that are in that sector.
Absolutely. So when it comes to insurance, we have the big names that everyone knows that caters for everyone. Then you have the smaller, more specialized insurance companies. And that's where you can make really a big difference by being better than the others and you get paid. We have mentioned Top Denmark, for instance. We have Renaissance Re, which is a reinsurer. And I think the biggest and most important thing when you're a smaller company, I think it's easier for you as a company to, when the pricing environment is not right, to actually shrink your book to keep your profitability. The big insurance companies almost have to grow no matter what, whereas the smaller one doesn't. And that really provides for good returns over time.
Well, Magnus, I think we'll leave it there. I think there's been a great update on the fund, and we're counting on you to have your second and third year as good as your first year.
We will try.
Can you
we
guarantee
will try.
that?
No guarantees, but I can guarantee that I will do my best, and so will the team.
Well, it's been our pleasure, and we'll do it again sometime, but I know our viewers have learned a lot more about the fund. Thank you.
Thank you so much for having me.